When the data doesn't make sense, we try to just not own it and
Right.
try to explain it away. But the reality is that there's been a lot of weird data right around the turn of the year. You had that strange housing starts number in December, which then rebounded in January. You had this strange retail sales number, which we think will also get revised. And I think this is just more of that. The 3-month moving average is absolutely the way to go. Look at the trend. The labor market, the trend was not 300,000 plus, which we had in January, and it's not 20,000, which we have now. It is somewhere in between. It's probably just south of 200,000, which is consistent with that 2% economy.
Somewhere in between, but I think the bigger question is it slowing? I mean, we've seen tremendous jobs growth, averaging more than 200,000 for all of last year. Can we expect those kind of numbers to continue this year?
No, it is slowing. It is slowing. But that's the point. There's a moderation activity. There's not a contraction coming. So some of the numbers that we have seen of late have been recessionary indicators. And I don't think that's right. So I think a slowdown and moderation is correct. And that means that we do need to see some rebound from a 20,000 print that we just saw.
Erin, what does this all mean for rates? I mean, clearly the rates outlook here in the US has been heavily influenced for years by the rates outlook abroad, particularly in Europe and Japan. Where do we go from here?
Yeah, so I think where we go from here is that we're of the view that we are in this new neutral where we're going to have a gradually, slower growth rate going forward. And a lot of this also is a normalization from some of the tax stimulus impact that we saw, really start to hit in 2018. As that starts to wane off towards the year end 2019, we do expect a slower outlook going forward. And so for rates, we think, gradually rates can rise a little bit from here, but when you look over the longer picture, we do think we're in this sort of new normal where real rates across the globe are going to continue to remain very low. And I think you did hear that. Sorry, go ahead.
Yeah. No, I just wanted to connect what you just said, Erin, to Maddi's world and what it means for stocks and whether we're at some sort of inflection point with a week like we just had.
Yeah, no, I'm going to corroborate with what Michelle said. I think, one number does not a trend make. We have to recognize we had a strong January, we had a strong December. And also take a look at the wage growth numbers. So while we saw weakness in the actual new job hiring numbers, wage growth was actually a little bit hot, which is actually a good sign for the economy and good sign that labor actually has some bargaining power where they haven't had the entire cycle.
Maddi, there's been a lot of debate of late as to whether the progress we've seen in US-China trade talks has already been factored into the markets, and on the flip side, whether negative factors like slower European growth has been priced in. What's your take on those two conflicting balancing acts?
So we're broadly expecting 4 to 6% earnings growth, and if we see that come through, we think we're going to see anywhere between a 2,900 to a 3,000 on the S&P this year with no multiple expansion. But we do think, to your point, there could be some upside surprise. I actually don't think that the entire positive China trade negotiations outcome is priced into stocks. So to the extent that we do get a positive outcome, whether it's Brexit or whether it's China, actually we do think that there's some upside to stocks from that more tepid mid-single digit number.